All right, guys, welcome back with another video. We're here. It's all about measuring investment returns. First, we have is calculating current yields. With current yields, you want to remember yields is a measurement of the amount of income an investor will receive as a percentage of the cost of the investments. The term current yields may apply to both stocks and bonds. If income is from a stock dividend, it's also called a dividend yield. So the formula for current yields, how to calculate current yields, you want to remember you take the annual income divided by the current market value. Annual income divided by the current market value. So let's say, for an example, there's an ABC corporation that pays 25 cents in a quarterly dividend. ABC stock is trading at 20 a share. And what would the current yield be? If the corporation is paying a 25-cent quarterly dividend, you'd want to take 25 cents times 4, because there's 4 quarters in a year, and then divided by the market price, which is $20. And that's how you calculate the current yields. And to calculate capital gains and losses, you want to remember when a customer buys a security and holds, it is an open position. Buy and hold is an open position. The position is closed by selling the security. In a short sale, the customer opens the position by selling and closes the position by buying. Capital gains are generated from closing an open position at a profit. Closing an open position at a profit is what generates capital gains. If you close an open position for a loss, then you have a capital loss. So the formula for capital gains and losses would be the sales proceeds minus adjusted cost basis equals capital gains if a positive number. Capital losses if a negative number. And then with adjusted cost basis is the amount paid for a position modified by any adjustments. So adjustments to cost basis most often come from a stock split or a stock dividend. When it comes to realized versus unrealized capital gains and losses, a realized gain or loss comes from closing a position. The position was opened either by buying or by selling shorts, and it is then closed either by selling or by buying back, and the position is flat. So flat means the position is no longer existing, no longer exists. When a position is closed, you can calculate realized gains, losses, and total returns. An unrealized gain or loss comes from an open position. So here you would use the current market value in place of the closing price of the security. You can calculate unrealized gains, losses, and total returns using the current market value. CMV. The problem with calculations on unrealized gains or losses is that the market can and likely will change before you complete the calculation. And then with calculating total returns is a measure of the return an investor receives from an investment that includes both income and any gain or loss. This is expressed as a percentage of the cost basis of the investments. So you remember the formula to calculate total returns. You would take income plus gains or minus losses and divided by the cost basis. When it comes to types of income, you have ordinary income versus capital gains. Ordinary income consists of several different types of income that are combined with earned income, investment income, and passive income. It is ordinary income that is used to determine the income tax rate that an investor will pay. When it comes to earned income includes salary, wages, bonuses, tips, and other income that is derived from active participation in a trade or business. With investment income is income earned from one's investments, sometimes called portfolio income. It includes dividends and interest payments. Investment income is income derived from an asset the investor holds. When it comes to passive income is a type of investment income that is derived from certain investments, primarily direct participation programs like limited partnerships and many real estate investments. These types of investments may produce passive losses as well as passive income. So a taxpayer who has passive losses in a given year may use those losses to offset any passive income received that tax year. And passive losses may not offset other types of income. When it comes to taxation on long-term capital gains, a capital gain is made when an investor closes a position for a profit. Capital gains are taxable, but how they are taxed is different than how ordinary income is taxed, and differentiate depending on how long the customer held the position. So in order to receive long-term capital gains treatments, a position must have been held for more than 1 year. This means that any position that was held for 1 year or less is short-term. Long-term capital gains are taxed at a lower rate than ordinary income. The actual rate is not tested because it changes regularly. And because there's a difference in how long-term gains and short-term gains are taxed, the classification of a position as long or short-term is very important to remember if it's long or short-term, because that determines how it's taxed. So if taxation on short-term capital gains. Capital gains made for assets held for a period of 1 year or less, once again, are taxed as ordinary income. So, in almost all circumstances, the ordinary income tax rate will be higher than long-term capital gains tax rates. So, short-term gets taxed as ordinary income. Short-term capital gains are not part of a person's ordinary income, but they are added to ordinary income for determining the amount of income tax an investor must pay. So it's not added to your ordinary income, it's just determined it'll get taxed like your ordinary income. So this means that effectively they are part of ordinary income, even though the law says they are different. When you add up your income to figure out your taxes, the short-term gains are added in along with other parts of ordinary income. And then when it comes to capital losses to reduce taxable income, the difference between how long-term and short-term capital losses are handled for taxes isn't testable, but what could be tested is the use of capital losses to offset gains. So capital losses may be used to offset capital gains on a dollar for dollar basis, as well as if an investor has losses that exceed gains in a given year, they may reduce, or they may use rather, up to $3,000 of those losses to reduce ordinary income. So if an investor still has losses in excess of gains in the $3,000, they may carry those losses into the next year. These are called carry forward losses, and they may be carried forwards until used with no time limits. As far as a wash sale, we know that an investor can use capital losses to offset capital gains. However, if an investor creates a capital loss only to offset capital gains for tax purposes, so sell at a loss, while still maintaining ownership of the securities, that is a wash sale. If the investor repurchases the same securities on or within 30 days before or after the date establishing the loss, that would be recognized as maintaining ownership. If this occurs, the loss may not be used for tax purposes. A wash sale is not illegal. Attempting to use the losses from the wash sale in order to reduce taxes is illegal. A couple wash sale rules that apply. You remember, rules apply to recreating positions, recreating a long position or recreating short positions. The rule applies for attempts to recreate the same position using not only the exact same security, but also substantially identical securities. So any position that may be covered or exercised into the same security as the one that was sold for a loss may be highly identical.